Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be analyzing CSX Corp, the railroad company. I had a request to do basically all the railroad companies and compare them to one another, but I'm doing them one at a time here. I don't think I've covered CSX on the YouTube channel before, but I did cover it back in 2019 on Seeking Alpha was the first time that I covered it. As always, this isn't individual investing advice. It's just how I analyze stocks. And I wrote a sell article on it back in the middle of, it was right around here somewhere in 2019. And we can see that my estimate was about the high end was 5% a year. It's done about 6 or almost 7% a year. I didn't pick the exact date of the article. When I looked, it was about 32% return or something like that. So pretty on target for what I thought. In the meantime, the S&P 500 is up over 100%. So definitely underperformed. I was reviewing that article. One of the things I noted was at the time they were basically borrowing money to buy back shares, which is going to show up here in this article. Usually when a business is doing that, it doesn't turn out good over the longer term. They can get short-term gains in things, which in my opinion is kind of what they aimed for, rather than, good, steady, long-term returns for investors. But we'll look at the numbers on that. Now, if we just look at the fast graph here, this dark green shaded area is their earnings per share over time. Let's see if we shrink this to this year's earnings. So again, similar to Union Pacific, we have like a 14% earnings growth rate, earnings per share growth rate, if we just go from the past like 20 years, which is really good. But I'm going to show you why it's not quite as good as it appears. We do have a few years where earnings declined, which we had 2009, 2016, 2020, and the past 2 years, and this year's expected to be flat, which flat when inflation's 3% isn't really flat. That's declining. But let's kind of shrink this down and see what we've done recently. So I'm going to use, the time period I used was I think I started in 2016 and went through forward 1 year here into 2025. So that's like a 10-year period. I'm going to use a time until payback valuation method for this one. So the idea is if you bought CSX Corp, if you just bought the whole business for yourself, how long would it take you to earn the amount you pay for it back? And then I'm also going to include their long-term debt. So long-term debt to capital right now is 57%. So when I do this valuation, I'm going to increase the current stock price by 57%. So you're buying the company, you're buying the debt, and then you want to see how long it would take to pay those back from the company via the company's future earnings. So in order to determine the future earnings, we need to figure out where earnings are likely to be this year, and then how much they're likely to grow on average per year, however long it takes you to earn your money back. I base that usually with an established long-term business like CSX. I use that mostly based on historical earnings. So I'll look at the past 10 years, give or take. I like to have a full cycle. I call it a full cycle analysis, actually, when I started doing it. But since we haven't had a full cycle since 2008, I don't really count the kind of COVID one because it was so weird. We've gone so long that I just had to kind of give up on that and make some other adjustments along the way to just, one, I have this recession PE metric that I use. Part of the reason I use that now is because a lot of times with my earnings growth rates, I'm not going all the way back and calculating in a recession. So my valuations don't have a recession in them. So I need to be careful that if there is a recession, I'm not buying too early. That's where all that comes from if you watched any of my other videos. So I actually think that the earnings growth rate that I come up with here is going to be pretty optimistic because we haven't had a real recession that's baked into it. The other way that it's going to be optimistic is we had huge tax cuts in 2018, corporate tax cuts. And for companies that are basically exclusively in the United States, like CSX, they got a huge, earnings growth that year from those tax cuts. Now, that growth isn't going to keep growing each year. It's kind of like what people say with tariffs now. Well, the tariffs go up, and they say that's not really inflationary because they just go up one time and then they stay there. It's not, whether you buy into that or not is like is more of a rhetorical thing than anything else, but it applies to tax cuts as well. If you get the tax cuts, this is real money that they made, but you're not getting those new tax cuts every year. So the growth, you can't extrapolate that growth out. So you need to be really careful about that. So that's going to be in any kind of, like, it has a 10, almost 11% earnings growth rate, measuring it from point to point here. That would probably be closer to 9 if you calculated in these earnings declines, right? Because if you're collecting the earnings as a business owner, it doesn't go in a straight line. So you need to be careful about these years where you're not actually, it's not a straight line. So once you calculate these slow years in, then you probably don't have as much money. Although we are kind of in a slight decline now, so it's not going to look as good as if it was at a peak. But even if the peak isn't very high, much higher than where we are now, so that's not too big of an adjustment. However, this giant earnings growth is too. You can also say the same thing about like COVID stimulus and things like that. So now this is maybe a bounce back year to some degree from the decline, but we bought a bunch of stuff. We transported it all across. A goods economy boomed. We have to transport all those goods, and railroads make money. So there's probably a couple one-time earnings boosts in here the way that it is. And investors need to be aware of that. And it's really these kind of things that make the difference between kind of an average investor who maybe isn't making really dumb mistakes, but there's some nuances where if you're just looking at the basic numbers and you don't kind of understand some of the other stuff that's going on, where you can make kind of a common mistake that is easily avoidable, is what I would say, with valuations, right? Because if you just looked at very long term and you assume they could grow 14% again for the next 20 years, it's going to look cheap. It might even look cheap if you think it's going to grow 10%, earnings 10% a year from here. But if you start using a little bit more reason, then you're going to have more conservative outcome. So if I just take this big year out here and I make one other adjustment, which I'll show in just a second, they didn't grow earnings at all since 2016, like barely, like 1% or something like that, which is lower than inflation. So that's important to keep in mind. And let me show you what that is. It's buybacks. As I mentioned in my article, I was going to pull it up here, but I didn't. Maybe I'll peek at it. Let me see if I have to look and see. I have so many tabs that it's just to show you guys what I'm talking about here. I think it was this one. Hey, I picked the right one. Okay, so here's the article, just to show you I'm not making things up. June 13th, 2019, the stock with dividends is up 32%. S&P 500 without dividends is up 105%. I did a sentiment calculation in this one as well. That's what I used to do back in the old days, and I combined it with kind of a similar thing that I'm doing now with earnings. So I'm just going to go down here to the kind of summary to show you guys how it all ended up. So my expected range of annual returns was about 1.5% to 5%. And then I note that I don't like it when the businesses are buying back overpriced shares with borrowed money, right? And I had to sell on it. I've written a couple other articles since this one over the past few years where I've just neutral on it. So because earnings actually rose quite a bit, as you saw. So they were actually earning money, despite however it happened. But yeah, very much underperformed. And we're into the time period now where once you get past all these one-time things, kind of reality starts to actually set in. And the earnings trends ultimately rule over the long term with the majority of stocks. So the other problem that I mentioned in my last article were these buybacks. Now, they bought back over a third of the business over the past 10 years. This charts the reduction in the shares outstanding over the past decade. So even though the forward returns, when I was looking at it back in 2019, like in the middle of 2019 were really not very appealing. On the high end, they were like 5%. The company was buying back their shares, and I didn't double check this, but according to my article when I was looking at it, they were borrowing money at the same time. So they were borrowing because interest rates were very low. So on the short-term math of things, it can make sense. Let's say they did expect a 5% return. Well, they borrow at 0, 1% or 2% or whatever it was, and they buy back stock of their company that they think can earn 5%, and maybe they think it's more than that. Who knows? People believe their own kind of delusion sometimes. So I don't know what exactly everybody was thinking there, but you can make the point I'm trying to make is you can make the math work, right? The problem is now you have this debt, and if you don't grow your earnings at that rate, then it doesn't end up being a very good investment. And you take on more risk for the business. Of course, and this isn't specific to CSX, but these executives, I think the average lifespan of a CEO is like 4 years or something like that. So unless you're Berkshire or some company like that, they don't take a super long-term perspective. And you can kind of understand why, because investors can be in Wall Street, can be in activist investors and everybody else, they're short term, so they don't care. They'll come in and kick the CEO out if he makes good long-term decisions that they have to suffer a little bit over the short term. Now, if you go watch like Berkshire, so Buffett bought Burlington Northern back in like 2011 or so. If you watch some of the Berkshire Hathaway meetings the past 5 years, there's always somebody that asks a question about precision railroading and all this stuff. And because it looked like CSX and Union Pacific were doing so much better, and Buffett usually kind of eloquently answered without saying the type of things that I'm saying now. But the thing is, they were making longer term. Berkshire was thinking longer term about their clients, their business, the investments they need to make into the railroad itself. Whereas a lot of these other CEOs, they don't have that luxury to do that. So they have to make things look good kind of all the time if they want to keep their jobs, a lot of times. I'm generalizing, obviously. So I'm kind of defending these, or explaining, I'm not defending it really. I mean, just explaining why sometimes they do dumb stuff. 3M did the same thing. If you go back and look at 3M, which I wanted to buy for a while, but when I looked at it, I mean, what they were doing with their capital allocation just didn't make any sense. But they were able to do that for years and years until finally the CEO got kicked out and they got a new one. And things had gotten bad enough where now people wanted to change, right? So it's just part of the structure of the system. But as individual investors, you need to understand some of these dynamics and just kind of how they're set up. So you don't fall for the kind of icing that's on the cake. Okay. Back to where I was. So yeah, I'm going to include all of this growth, including the tax cuts. Who knows? Maybe we'll get more tax. We might get more tax cuts. It doesn't look like they'll be as big as they were before, but they're trying to do it again, which should juice some of these earnings again, right? If it ends up passing. But what I am going to control for are those 35% share reduction in shares, because when you're using earnings per share like FastGraphs is, which is a perfectly good way to do it, especially in the beginning, as long as you pay attention to things like these share buybacks. When you reduce the share count, it makes the earnings per share higher because it's a ratio. But it doesn't really mean the company's earning any more money. Like if you look at the 3-year revenue number, I don't have it pulled up here. For CSX, it's like 11%. So what is that? Like 3% a year or something like that. That's how much revenue growth they've had. Well, inflation's been that's the last 3 years. Inflation's been 3%. So they've had no revenue growth the past 3 years. I didn't look at it longer term. But you just need to look through those numbers and kind of see what makes sense, because it's trading at a 17 PE. So if there's no earnings growth, if there's not really much earnings growth, it's going to take a long time. And that's not even using forward earnings here, which are going to be lower, it looks like. Oh, the same. It can be the same. It's going to take a long time to earn your money back. So let's look at that. When I do the calculations and I include the share buybacks, but I don't control for the tax cuts or the stimulus money from COVID, this is kind of what we're looking at. I accidentally scrolled down super low here. Give me just a second. Should be rolling down. I use this spreadsheet more as like a worksheet than anything else for these videos. Okay, so 17 years is how long it would take. So I showed you that 17 PE. And especially once you adjust for their debt, which I did adjust for the long-term debt, I adjusted the stock price up 57%. So you have all these things. You have buybacks, which make earnings growth look faster. You have increased debt, right, which is not shown in the PE ratio. So you want to control for that, because if you're actually buying the business, you need to buy the debt too. And I just used the long-term debt to capital that was on the fast graphs. And then you look at what they're actually like growing, and sometimes earnings fall, right? So when you do all that and you put all that together, it's going to take about 17 years for you to earn your money back as a business owner if you were to buy the company and its debt, and you assume earnings grow at about 6% a year. So the 6% a year is, I think, pretty generous, unless it results from inflation. They have the ability to pass inflation on. Even in the last 3 years where they haven't grown, they've been able to pass inflation on, basically. So for the most part, at least on the top line. And eventually they probably would be able to do it on the bottom line. So the good part about it is, compared to like a bond, a long-term bond, which can't pass inflation on, which we're likely going to have more inflation, I think, if we don't have a bad recession or depression or something. So that's the good part, even though it's a 3.65% earnings yield, it grows a little bit. You compare it to the 10-year bond, right, which is 4-point-something% right now, which is a little higher. But if there's more inflation, the bond isn't going to rise. It's just a fixed amount, like fixed income, right? That's what it's called. But they could adjust for that inflation. So this is actually probably really in line with like the 10-year treasury, which I think is a bad investment right now. But it would take 17 years to earn your money back with these assumptions if you bought CSX. To me, that's a sell still, just like it was back in 2019. I just don't find, I would rather have a short-term treasuries yielding 4.5%, honestly, and then wait for something to get cheaper. So this is the exact same time until payback as Union Pacific was, even though they had some different metrics that went into it. So you can kind of also see that the market is valuing these two railroads pretty similarly, which is not uncommon. But to me, that's overvalued. I'm not sure. I haven't quite figured out what the market's thinking paying this much for these. I don't know. They are domestic oriented. I don't know. If I was thinking about buying them, I would probably think more about it. But sometimes I just look at it. I'm like, well, that's too expensive for me. I can find a better deal elsewhere. So those are my thoughts on CSX. If you found this useful, hit the like and subscribe button. I have a free tier over on Patreon where I post all these videos. And I'm probably going to start posting some videos just exclusively on that free tier over on Patreon to get some more people over there. Haven't quite decided on that yet. I'm going to wait until maybe next month, and then we'll figure it out. But I have weekly picks over on Patreon. Those have been beating the S&P 500 since I started that in October, and they've been doing really well. So check that out. That's $25 a month there, and I'll see everybody later.